Okay, final video here. And we're taking a look at a note receivable that is what's called being dishonored. So the previous videos, when we discussed getting to the maturity date, we were always able to collect on the note receivable. So we recorded the cash payment of the principal balance and any interest that was still outstanding. This is what's called an honored note. So we were able to collect it, meaning it was paid in full at maturity. So we recorded that collection. We got the cash. But it's possible, just like accounts receivable, that whoever has this note outstanding, so the person we've lent money to, might not actually be able to pay us. So when we get to that maturity date, we might not be able to collect on the note. And this is called a dishonored note, or it's sometimes referred to as in default. So dishonored means that it is not paid at the maturity date. We're not able to collect, and therefore the note is no longer negotiable. So basically this just means that legality of the note is sort of gone. So the date has passed, and therefore we want to move it out of notes receivable. But since we haven't collected it, it's not that we're going to just stop trying to collect it because the maturity date's passed. Obviously, we're still going to try and get this amount. It's just going to take a little extra time. So to do this, we actually transfer the balance into accounts receivable. So it just sits there with the rest of those amounts, and our collection staff, so our accounts receivable individuals who work to collect any old balances, they now will see this amount sitting in AR and they know that they need to try and collect it. So it's just moved, but we're not getting rid of it. We're still trying to collect it. An example here says, suppose that on February 3rd, a 6-month 10% note receivable for $5,000 is dishonored. And we're going to just add here, assume no interest has been recorded yet. So nothing's been booked other than recording the issuance. So 6 months ago, when we took on this note receivable, we would have debited the note receivable, credit cash. For example, let's say we lent cash out. So now we get to February 3rd, and it's the maturity date. We're looking to collect this, but since it's dishonored, we weren't able to get that in cash. So our debit here instead will be accounts receivable. So we didn't get any cash. Instead, we have to move the amount and put it into that accounts receivable balance. We're going to credit our notes receivable. And we're taking it out of this note account and transferring it to AR. So the note is $5,000. And the 6 month has already passed. So we want to record the interest that we've earned. We've lent this money, we've earned the interest. So we still book interest revenue in the same way that we would have previously done that. So we can calculate the interest, our principal of $5,000 times the 10% interest rate, and it was a 6-month note, so we multiply that by 6 out of 12 months, which gets us $250 of interest. So the total, we move this full amount into AR because this individual that we lent money to, they owe us a total of $5,250. So that's the amount that will be sitting in accounts receivable. Okay, so that looks at everything to do with notes receivable. Now, the last thing we're going to look at quickly is just discussing how we report receivables on the balance sheet. And really the biggest thing to talk about is the accounts receivable portion and how we deal with the allowance for doubtful accounts. So when it comes to ASPE, which is most common in Central Alberta, it's actually not necessary to present the allowance for doubtful accounts right on the face of the balance sheet. So this should actually say on the balance sheet. So it's possible, instead of showing your full AR minus the allowance and getting the net on the balance sheet, you could just show the net amount. But if you do that, so if you don't show AFTA on the balance sheet, then the company must actually use a note, and that's where they would give the details of the accounts receivable. So here's an example of the two options that you could see. So this is just a partial look at a balance sheet. So we've got our current assets here, we have cash, we've got some inventory, and you can see now that all we're showing is accounts receivable net, and the amount is $2,000. But since we haven't shown the details right on the balance sheet, we now have this reference to note 1. So the user would look a few pages away into the notes of the statements, they'd find note 1, and here are all the details. So we've got our gross AR, $2,250, less the AFTA, gets us to this net amount of $2,000 that is actually shown on the balance sheet. So that's one way. The second option is to just show the full amount of details on the balance sheet. So we've still got our cash, our inventory, but now here we've actually showed our full AR less the AFTA to get to this net $2,000. So either option works, but somewhere in the statements you need to have these details. So if you want to just keep your actual balance sheet as short as possible, you could show the net there, the details elsewhere, or just show it all on the balance sheet. Okay, so that is chapter 9 all wrapped up. I know that the videos were a little long, went a little over our 2-hour class time, so I appreciate you sticking it out and getting through all of those. I'll post some examples in the practice section for you to try out, and then we'll go through some more in our live class as well.